why don't we just start out with you just introducing yourself and tell people about your practice.
Okay. So my name is Ted Lanzaro. I am a fellow real estate investor and a CPA who specializes in representing real estate investors and run a boutique tax strategy firm located in Cheshire, Connecticut, which is 20 minutes north of New Haven. But I work pretty much on a national level. So I have clients that call me from around the country, and it's amazing what you can do with, the telephone, email, FaceTime, Messenger, all the different things that you can do. So just to kind of start off, I've been doing real estate investing for 17 years. I've been a CPA for close to 30. My real estate investment experience personally is landlording and flipping single family houses. I've done some small friends and family kind of syndications. And then from a client standpoint, I've been involved with, my clients range from anywhere from people who own large apartment buildings, office buildings, shopping centers, to literally the guy who owns a two-family house on the street. So that sort of gives you a little bit of idea where I'm at. A few years ago, I noticed that there wasn't a lot of real estate, there wasn't a lot of plain English real estate tax guides. I had a number of them from gurus that I had, seen on stage and purchased information from, but all of them kind of read like a law book, So I decided to put together just a small tax strategy guide for investors. It kind of spans the gamut of what's out there for real estate investors. And then when the new tax laws changed at the beginning of 2018, I updated everything. So you now have the most updated edition of this book, keeping in mind that they're still tweaking some of this stuff.
So I wanted to ask you, most of the people who are here in the group today are trying to learn how to be syndication sponsors.
Okay.
Right? So I'd love for you to talk a little bit about, from the perspective of a sponsor, what are your kind of tax advantages and disadvantages, or like for instance, before we get into the issue that we were talking about on Facebook the other day, there's this real estate professional issue which determines like how your income is going to be taxed.
Mm-hmm.
So
yes.
why don't we talk about that a little bit? If you can explain what a real estate professional is and how you are characterized as one or not,
Sure.
and what it means for your taxes.
Okay, so there's typically three types of investors, okay? The first kind are passive investors. Those are going to be the people that you bring in to your syndications, okay? They're not going to have any say, they're going to give you money, they're going to own a piece, but they're going to be essentially silent partners or limited partners, right? You're going to be managing the sponsorship and possibly the property, unless you're going to hire a manager. So those people are not allowed to take losses against their ordinary income. They can only take losses from your deal, say, typically in the form of depreciation, against other passive income that they may have. If they don't have any other passive income, then they basically get what's called a loss carryover that will carry over to future years until you get income. Okay. The second category is active investor. And an active investor is typically somebody who is managing their own properties, okay? And they are eligible in that scenario to deduct up to $25,000 a year in real estate losses against their ordinary income, unless they make more than $150,000 a year, because the $25,000 loss that you're allowed to take phases out between $100,000 and $150,000 of adjusted gross income. So once you hit 150, you might as well be a passive investor. Okay, so you still have that carryover. Now, how many of you who are wanting to do these, these syndication deals, how many of you have regular full-time jobs? Okay, about half. Okay, so in order to be, and how many of those jobs are actually in real estate? Okay, all right. So in order to be considered a real estate professional, okay, you need to do a couple of things. One, you need to be able to document that you've worked at least 750 hours in your real estate business, okay? And there's an election that you need to make that says, I'm combining all of my properties into one aggregated group, so that, because what the IRS would come back and say, if you don't make that election, is you needed to spend 750 hours on each property. So if you don't aggregate your activities, then you could lose in an audit. You can lose your status. The other thing that the real estate professional status rules say is it has to be not only 750 hours, but more than half of what you do. Okay? So if you're a lawyer or any other profession that's not related to real estate, and you're working 2,040 hours a week, 2,080 hours a year, you're probably not going to qualify as a real estate professional, because even if you put those 750 hours in, you haven't gone over the 2,000, you haven't gone over the 50% of the total time that you spend. You'd have to work 2,081 hours. Essentially, you'd have to be a lunatic, at that point, right? The big benefit of qualifying, though, is that you get to take unlimited losses against your ordinary, unlimited real estate losses, rental losses against your ordinary income.
So how does this affect you as a sponsor? Like if you're getting like a promoted interest or carried interest on your deals, and you're getting that as income, let's just say like you paid your preferred return,
Mm-hmm.
you're into your split, you're taking that as income, how are you taxed? Like, is it still if you qualify as a real estate professional, are you taxed as?
Are we taking income or are we taking losses?
Well, okay, but do both situations. So if you
Okay.
take, yeah.
Okay. So setting aside the carried interest rules for just a second, right? You have this syndication, right? And to the extent that you are allocated income and loss, and again, this is very deal specific, by the way. So to the extent that you're allocated loss, for example, to the extent that you have basis to take that loss, you have money in the deal, right? You're allowed to take some of those losses. If you're a real estate professional, there's the amount of those losses that you can take are unlimited. Okay, so you won't get phased out of anything. The question that becomes is, if I'm doing a deal where maybe it's 100% carried interest, I haven't put a dime in the deal, right? Well, now I've got a basis problem. I can't take those losses and they will continue to carry over until I get past my preferred payouts and start getting allocated my own income. So there's only two things that increase. Well, there's three things that increase basis. There's the money I put in, the income that's allocated to me, and whatever debt that I personally guaranteed that's recourse debt. So there's those kind of deals those are the things that give you basis to take losses. Does that make sense?
Yeah, so I'm curious, especially because this conversation came up in the Facebook group, where let's say you're a sponsor, you're into your share, you're into your split,
Mm-hmm.
income is coming to you, but the property has a lot of depreciation.
Right.
Right? So is that depreciation, does that hit your sponsor's piece or not? Or is it just deal specific if you're allocated it? You see what I'm saying? Like, it's just
I mean, a lot of it is deal specific,
Yeah.
I think, because everybody's got a different, so think about it from this standpoint. Not only does everybody in this room have an absolutely different tax situation, right? So some of you won't qualify as professionals, some of you will qualify as active, but also some of you may have a whole lot of properties and you have a lot of mature properties, say for example, so you have a lot of income, right? So to the extent that you have that income, then if you get passed through losses, you're able to take those losses against that other passive income that you're getting. So it is deal specific because of the way the deals are typically written, right? So, and I haven't been involved with a lot of these kind of like low where there's major carried interest deals. Most of the syndications that I've done personally have been more friends and family, kind of we throw in some money, we buy something. So, but yeah, I mean that's where we are with.
Yeah, let me give you like to make it
give me a scenario.
specific example. Would probably be easier for you to talk about. So I'll just say like how we structure my deals.
Mm-hmm.
So we'll put a deal together, raise $1 million of equity or whatever. I'll put in say 50,000. I'll buy one share, right? But then I'm getting a promoted interest. So let's just say in a given year, the investors are getting paid their 8%. We make $100,000, the whole property, right?
Right.
The investors get 80, I get 20, right? As the promoted interest. I'm also, as an investor, getting whatever my share of that 80 is, right? And let's just say for illustration purposes, that the depreciation deduction is worth $150,000, right? So
you actually have a $50,000 tax loss.
Right. So the $50,000 tax loss on that property. Who is getting what? Is 100% of it going to the investors who put in money, or is 20% of it coming to me because I get 20% of the profit? Okay. How does that?
In the syndication deals that I've been involved with, it would be based on your allocation percentages. Okay. Now, that's the allocation, right? So there's a difference between allocation and ability to deduct. Does that make sense?
Well, what's the difference?
Well, I can get allocated. Okay, so in your scenario, right, you've got this $50,000 tax loss. You own 20%. You've got this carried interest. So let's say you get allocated $10,000 of loss, right? That's right, $10,000 worth of loss. 20% of $50,000 loss. Let's say you get allocated that 10. If I don't have any basis because I've got 100% carried interest, then I can't deduct that $10,000, even if I'm a real estate professional, because the passive loss rules are going to supersede any of the other rules, unless I have other income from someplace else that I can offset against. Does that make sense? It is a carry forward, yes.
But just to be clear though, so for me as the sponsor, collecting my 20% of the profits as the sponsor, to be allocated 20% of the loss, if there's a loss, is that automatic because I'm getting 20% of the upside, or is that specifically something that you have to account for in your operating agreement? Like, does the operating agreement have to say... I think
it's something you specifically have to account for in your operating agreement. That's my understanding.
Okay, so that's the point I wanted to be clear. Like, there's not... I think what you're clarifying is, and what I understood, is if you're not specifically in your operating agreement telling your investors, like, hey, as the sponsor, I'm also getting the same percentage of any losses, you don't get any of it. It's all 100% of that's going to the people who put in cash. Is that?
Yeah. I mean, listen, your operating agreement is really important, and having a good syndication attorney who, and I'm sure you have somebody you recommend, but having a good syndication attorney who advises you on all of these things is obviously a requirement. But from my standpoint as an investor, and from your guys' standpoint, looking at it from an investor, I'm going to try to get the best deal as a sponsor as I can negotiate, right? I mean, so it all depends on, it's all deal specific, because I only want to give away that which I have to in order to get the deal done. Make sense?
Yes, I think the important thing to note is like sort of how how you feel and how your investors are going to react. Like if you think your investors are going to be fine with putting up this, in the 70-30 situation, 100% of the money, but only getting 70% of the tax loss, if there is any. That's just something that they have to understand and they have to be comfortable with. Also, you have to feel like how you feel about it as the sponsor. So, but there's no, from what you're saying, there's no sort of like tax law default position on this. It really depends on how how the upside and the downside is allocated in the agreement, and then the tax laws kick in.
Right, exactly, yeah. And also, thinking about it from this standpoint, your passive investors are the people who benefit probably the least from from being allocated losses, at least in the current year, unless you're dealing with people who have a lot of passive income anyway. You know, if they do, those would be, then that's a bigger, so if you're putting together a deal and you say, well, I've got these 10 potential limited partners, right? And you know that none of them have other passive income. Well, that might be an important thing to know, because you could, and you say as a sponsor have a lot of passive income, so you can be allocated losses. That would be something that would be interesting to know, because you could tweak the deal that way, and you can do it the opposite way too. If you have 10 investors that you know, hey, all these guys are wealthy real estate guys with a lot of mature, positive rental income, well then being able to allocate them some loss that they can take is very valuable to them, because it's a tax advantage. If they're in the opposite scenario, it's a lot less tax advantageous. It will be in the long run, but in the short run, it isn't. What's kind of interesting too is, how many of you guys have done deals where you bought a property that you had to fix up before you could put tenants in it? People do that? All right. So there's a way to, if you buy a big enough property and you can do a cost segregation study on it, right, and you're going to fix it up, you actually end up doing, say, for example, 2 cost segregation studies. You do an initial study that identifies everything that's in the building, right? And because when I go to do my renovations, and I have my scope of work that I'm going to do this renovation from, I'm also going to be identifying all of the things in that cost segregation study that I threw away, okay? Because I'm going to take a tax loss for those things. I bought those things, I'm going to take a tax loss. So a client of mine purchased a apartment complex in Lexington, Kentucky, and it was a fixer-upper, right? So they went in, they paid $7 million for this property, and they did an initial cost segregation study, and they were able to identify, once they were done renovating, they were able to identify $1.5 million of assets that they literally threw away, okay? So now it does reduce the basis, so their basis, and their total cost basis in the property went from 7 million down to 5.5. But every member of that syndication got a piece of that $1.5 million loss right up front. And that's an ordinary loss, not subject to any of the passive activity rules. Okay? So you want to keep that in mind. Then when they went and they put, say, another $2 million into the property, because we threw away $1.5 million, we had to replace all those kitchens and bathrooms and whatnot, right? They still got the benefit of the depreciation on all of the new stuff. Okay, that depreciation was subject to passive activity losses, so their passive investors couldn't take those losses. Maybe depending on what their individual situation was, could or could not take those losses in the year they got them. But all of them got that abandonment loss. Go ahead.
So if you're a passive investor, and let's say, I don't know, you give $100,000, so how much passive losses do you get that first year? You get $100,000 losses on your taxes?
I mean, it all depends on what you're allocated, because if you put $100,000 into a deal and then your K1 says negative $100,000 under rental real estate losses, then yes, you'd be able to deduct that whole 100 if you have the other 100, and so you have the basis to take the loss. Do you have the $100,000 of income, other passive income to take the loss? If you don't and you're passive, it doesn't. So
you say the first example with the $1.5 million. Can I?
Oh right, okay. In that order, yeah. Okay, so yeah, exactly. Okay, so I'm sorry, I misunderstood your question. So if you have $100,000 in, right, and you got allocated $50,000 of that loss, okay, that ordinary loss, yes, you would be able to take that $50,000 loss in the year that you in that year, without worrying about your passive status, without, the only thing that would be considered would be, did you have the basis to take the loss?
So I think, I just want to clarify something about this, because I think he's talking about putting equity into a deal. You can't deduct equity you put into a deal, right? I mean, that's a different issue, right? You can't deduct.
The equity,
Yeah.
the equity in your deal gives you the basis to be able to take that loss
On the income. like
on the
operating income, right?
on the operating loss.
Right, well, operating loss.
Right, on the operating loss. It gives you the basis to take it. And think about it from this standpoint, your capital account has decreased by that amount also. So you have a smaller capital account now. Okay, and then your capital account will grow as the investment makes income, and will decrease as you get distributions of income, that sort of thing. So
What's the importance of the capital account?
well, in this scenario, the capital account, to some extent, represents your basis, okay, right? So keeping track of that tells you how much basis you have in the property in order to be able to take losses as they go. Now, there's other ways to get basis, even as a passive investor, depending on how the agreement could be made. But typically, it's going to be, hey, I put this $100,000 in, my distributions decrease my basis, any losses I take decrease my capital account and my basis, and any income I get increase my capital account and increase my basis.
Question.
Go ahead.
Ravina,
So,
speak up.
so for that initial cost set, does it matter whether you were able to pay the tenants and then take the cost set in the first year or not, or is PREP for the property not to be livable?
So the question is,
Make it ordinary loss.
so the question is, for the recording, as I think I understand it, the question is to take that rehab loss as ordinary income, as an ordinary loss that Ted was just describing. Does the property have to be uninhabitable for the time that you're
No.
using it, or doesn't it matter?
No, they were doing rehab at
Like turning units as they
turning units and rehabbing as they went. Now they did have vacant units, so they did literally gut rehab on every vacant unit they had in the first year. But they also were they were turning apartments as they were rehabbing as they were turning apartments.
So by definition, as long as the cost set is done within the first year, you can take it as ordinary loss against your tax basis that you're doing.
I mean, there's probably a way to go back and do that. Would be the best way to do it, okay? Because you've identified everything pre-renovation, okay? Now, I have seen and been part of, kind of post-renovation cost segs that attempt to define the abandonment, okay? And but those are going to then be based on, hey, did I have pictures? Did I have layouts and pictures and all that stuff up front? Because the engineers have to base that on something, right? So, and they might just base it on, let's say you had, just as a stupid example, you have 150 identical apartments, right? And you've got pictures of a couple of them, well, we're going to assume they're all pretty much the same, So, yeah, you can do a post-renovation cost seg to identify abandonment, but it's better if you do it, it's more formidable if you did it up front.
Do they have to be, with some of those vacant units that are being rehabbed, per se, do they have to be placed in service even though they're not habitable, or it doesn't matter?
Well, in this scenario, it wasn't like they weren't uninhabitable, okay? So I get where you're going with this. In other words, if the entire place was empty, right, okay, you would still be able to take those ordinary losses, okay, because you paid for them. Think about it. When you buy a building, let's say you bought this building, right? Well, I paid for that, I paid for the lights, I paid for the floor, I paid for all of these things as part of the building. So a building is nothing more than, a whole bunch of different components that you can break into pieces if you want to, right? If you have the ability, the engineering background, the accounting background to do that, right? It's the same thing as if I bought a computer, used it for 6 months and then threw it away. I haven't fully depreciated that computer. I can write off the balance. So that's all we're saying. We're allocating, based on an engineering study, allocating these things that we purchased, we spent our money on, and now are gone. They're not here anymore. Okay. Now you've reduced your cost basis. Don't forget too. So your cost basis is now in this scenario is 5.5 million. So if you went and sold it, so if you gutted everything and took this loss and then went and sold it in the same year, right, you'd have an offsetting gain probably, right? So it would probably wash out at that point. But no, I mean, what you're in the scenario you're talking about, you would write off that 1.5, but then you would capitalize as improvements everything that you put back in, and then you would have to do a second study.
And that raises your basis.
And that raises your basis. In this scenario, they went from 7 to 5.5 to 5.5 and back up to 7.5 because they put $2 million back into the property.
Chris, you had a question.
You may have already clarified this, but I missed it. The ordinary loss and passive loss, they both reduce your basis.
Yes.
Okay.
Yes.
I just want
So-
to be sure.
Let me ask a little bit more about depreciation,
Mhm.
because we were talking about losses, but I think we kind of missed a step. Was even if you can't take the loss because you don't have any other passive income to offset it against, you're still getting the benefit of not paying tax on the income, right? Because
Yes.
yeah, so
Absolutely. Yeah, absolutely. Yeah, because think about this, the ideal with a passive investor, your passive investor that doesn't have the ability to deduct losses is still going to be at zero
for tax.
for tax purposes. They could have collected their 8% preferred return in Jonathan's example, and maybe they pocketed 10, 12, whatever the deal is, $15,000, and but they don't have to pay tax on any of that.
Yeah, so it's always like an important thing to tell your investors is like, hey, you can show them the depreciation that's going to, because you know the purchase price of the building, even if you don't do a cost seg, you can pretty much estimate kind of what it's going to be.
Oh, yeah, absolutely.
And then you can tell them like, look, hey, we're going to have, this is going to be spitting out $100,000 of income in the first year, but we're actually going to have 150 of depreciation. So you're not going to have to pay any tax. This is all going to be tax-free, well, tax-deferred income.
Yes.
Let's talk about that too, because I think this is really important. Like I see a lot of investors getting very excited about depreciation because it knocks out all your income, but it's not. This is not free money, right? Like you got to pay the piper eventually. So
Yeah, you do. Yeah, because so depreciation is basically a rational allocation. If you were to use an IRS definition, it's a rational allocation of the cost of the building, and the IRS determines the useful life. So just using, let's say, for example, the IRS basic use residential apartment building, 27 and a half years, okay? And without getting fancy about everything else, let's just assume that we have a $2.75 million property, so we're going to divide it by 27 and a half years, and we're going to depreciate $100,000 a year, right? So, and just for the purposes of example, let's say we have $100,000 of income in those years too. So now we're going to have zero taxable income. Okay, all of our cash has been, all of our net cash flow has been offset by this depreciation. Okay, now we get 10 years down the road. Okay, we've depreciated $100,000 a year. Okay. We have $1 million less basis than we started with. So when we sell the property, okay, and we go to calculate the gain has, the gain calculation has this $1 million worth of depreciation factored into it. And there's a recapture of that depreciation to bring you back to at a different tax rate before you calculate the long-term capital gain on your property. So depreciation is a deferral, okay, and it's a time value of money gain, okay? The same way putting money in a retirement plan is a tax deferral kind of strategy. You will ultimately If you put it into a traditional plan, you'll ultimately pull the money back out and pay taxes on it. But so you will ultimately end up paying taxes on the money you make. It's just that you've offset with depreciation. It's just a matter of when. So if you told me, hey, I'm going to do this deal, but I'm going to sell the property in year 2, should I do a cost segregation study and take bonus depreciation? I would say no, don't do that. Not smart. There's not enough time there to reap the benefit of the time value of money. But if my intention is to hold the property for 7 years, 10 years, forever, okay? And you'll see in my book, I'm a big proponent of holding properties, at least the ones I own, forever, okay, and giving them to my children. So the thought process is, the longer I hold the property, the more valuable those depreciation deductions were in years, because the value of that money in year 1, the value of that dollar in year 1 is going to be much higher than that value of that dollar in year 15 or 20 or 25. Does that make sense?
So also, talking about this issue, I think a lot of people too sort of get very excited about cost segregation because of all the savings, tax savings you can have up front. But then again, you have to have the offsetting income to make it worthwhile, and you're also reducing your basis even faster, right, with the cost segregation.
You are reducing your basis faster. You're reducing the basis in the property faster. Yeah. And again, if you say, for example, you came into my office and you said, I just bought a building and here's the way I structured it and here's how we're going to do it. And we're going to sit down and I'm going to look at your tax return and I'm going to say, yes, that's beneficial to you. No, that's not beneficial to you, and I'm going to tell you why. If you're a real estate professional, for example, and you're going to get allocated some of that loss, and you're going to be able to take that loss, and you don't have a whole lot of income to take it against, there's less value to that. So there's more value to taking a loss as a real estate professional for somebody who has $400,000, $500,000, $600,000, $1 million worth of income, who's paying taxes at 35%, 40% in New York, right? Then there is for a guy who took his whose only income is maybe his $100,000 acquisition fee for doing the syndication, and he's now gonna he might have, his benefit on taking those losses is 20%. Does that answer the question?
Yeah.
Okay.
So on that real estate professional thing, you had mentioned that you want to aggregate it so that it's all, so you get multiple properties. So in the eyes of the IRS, what actions would you need to take in order to have it recognized as aggregated? Like, do I need to put it all under one entity, under myself personally? What do I need to do to meet that qualification?
Let me ask the question again so the video can pick it up. So the question is, in order to qualify for the proper treatment as a real estate professional with multiple properties, do you need to, Ted mentioned that you need to aggregate it. What does that mean? You have to aggregate it under an entity, or what's the election that you have to make? So how do you do that for the IRS?
I mean, literally, there's 2 elections. And again, our tax software does this, but you hit X and it prints out a statement that says, I elect to be treated as a real estate professional. And I qualify and elect to be treated as a real estate professional. Right? And then you hit the next button and it says, I elect to aggregate all of my real estate related activities as one activity. And it's literally a sentence. Okay?
Great.
A minor follow-up to that. I swear at one point I ran across a webpage that said there was a minor disadvantage to being a real estate professional, and I don't know if it had something to do with exchanging, or are you aware of any disadvantage to claiming that you're a real estate professional?
I'm not aware of any disadvantage of claiming you're a real estate professional. There are some disadvantages of being declared a dealer.
Yeah, I know.
Okay, so that would be that scenario.
Your
Oh,
example,
Tom, you go first. Yeah.
okay. Your example of the depreciation of $1 million on a $2.75 million investment. Where does 1031 exchange come into this to protect And how much would you have to roll into another investment to protect yourself from capital gains?
Okay,
Yeah,
all right.
So the question is, when you have that reduced basis, in the example that Ted was just talking about, and you want to protect yourself on a sale from having to pay tax, now where does 1031 come in?
Okay.
Yeah.
So you're going to do a 1031 exchange, right? You're going to sell the property, you go and you say, I'm going to do a 1031 exchange. In that scenario that I was describing, your basis in that property now is $1.75 million, okay? The 2.75 you bought it for minus the $1 million of depreciation you have. Your basis carries over to the next building, okay? Now, let's say you sell that building for $3 million. And again, this is it's a lot more complicated than this, but I'm giving you the basics. Okay, if I sold that building for $3 million, I now have to reinvest that $3 million in another building. Okay, let's say I put exactly $3 million into another building. Okay, I'm deferring $1,250,000 of gain, right? But my basis in that property is still $1,750,000. Okay. Now the problem that you have now, sort of was you were addressing this when I walked in, is 1031 exchanges these days are awful hard to do. Why? I have to identify a good investment in 45 days, and I have to close on one. What's that?
Does it change from state to state? I'm under the impression it's 180 days.
180 days to close.
Yeah.
Okay, but I have to identify 45. Okay. I have to submit my identification of properties. I can submit 3 properties and close on 1. Okay. But good luck finding one good property that you want to invest in. Okay. So the thought process is, and I tell people this all the time, why do you want to do 1031 is a great strategy, by the way. Okay. And I know people, and personally have had clients who have taken a lot of doors, a lot of small, units, and gone and taken that in a rising market to the shopping center level, okay, and then put money into those shopping centers, built them up, put new tenants in them, sold them, and went into sort of triple net managed stuff. You can buy 6 auto zones in Texas, and then just collect a check for the rest of your life and never pay the capital gains on any of that along the way, right? Very powerful strategy. But it's a powerful strategy to use at the right time, okay? So now, if somebody is advising me, I'm saying to them, okay, great, you have a property right now that's making you 15% a year. Why would you trade it for a property that's making 6% a year, right? I'm bored. Right? That's typically the answer. I'm bored with these properties. I want to move up. I'm tired of managing 150 doors. I want to manage 1 big door, right? Okay, well, that's great. Not the right time to do it now.
It's interesting that you raise that, because I've been talking about this in the context of everybody seems to want to maximize their sale profit and then do a 1031, and they can't find an exchange property, right? And to my mind, it seems like they're not acting very strategically. They're only acting on one half of the equation, right? Which is maximizing the gain in the first one, but then they're kind of screwing up in the second one. When I got into the business, I remember seeing people selling properties at the bottom of the market, and for the life of me, I couldn't figure out why they were doing this until I realized much later that they were selling off these older properties, and maybe the first properties they bought, they had built up a lot of gain in them. They would have had a lot of tax, but now what they were going to do is just they were gathering cash so they could buy really good assets at a really good price and move up that way. And that was the strategy, and they're using 1031 to do it, as opposed to trying to do it at the top of the market. There's a timing issue which may make it more, just like you were saying, more advantageous to do it at a different point in the market, because you're thinking about both halves of the equation.
Yeah, no, exactly. I think, it's just in this market, and look, if you're trying to replace a $250,000 property, easy. If you're trying to replace a $3 million property, much harder, because You've got a lot of competition at that level.
Are you seeing any of your clients go into a Delaware statutory trust at all? The DSTs?
I am not. You know, that is not a strategy that I'm seeing. I'm not saying it doesn't happen at
Sure.
higher levels than I work,
Mhm.
you know, but I'm not seeing that.
Yeah, this question was about Delaware statutory trusts. There's someone who hasn't spoken yet.
So earlier you talked about three ways to gain basis with property. One was the amount you put in, another was recourse debt. Non-recourse debt does not qualify as a way to gain basis in property.
Not to my knowledge, no. I mean, if you
I'm
personally,
thinking, all right, you buy a property, you know,
Okay.
you put together a group syndication, right?
Mhm.
You put down, say, $1 million on a $5 million property, and you get debt for the remaining $4 million. If you want to start taking depreciation or bonus depreciation, say you are a real estate professional, you can't use the full $5 million as your basis, you can only use the amount you actually.
well, there's rules that are called, did you want to say the
Yeah.
question?
Yeah, so just trying to understand the question. So you're saying, so you invest, you buy a $5 million deal, you put in $1 million of equity. I'm assuming you're talking about from a sponsor perspective,
Right.
right?
Right.
And it's non-recourse, and I also assume that you're saying you haven't put in cash. You're not talking about any cash you might have invested, but just on your sponsored piece.
Yeah.
How do you obtain a basis for deducting any tax losses on your sponsor piece, and you're taking non-recourse debt? So this is a great example because we sort of had forgotten about this. What is the difference from a tax perspective of recourse versus non-recourse debt? And how does that work if you take recourse debt, how does that work to get your basis in the property so that you can take the deduction?
Right. I mean, there's rules, they're called at-risk rules, okay, with the IRS. And they're complicated, but the basics of them are, if I have a personal guarantee on that debt, then I can get basis. That gives me basis. To the extent that I don't have a personal guarantee on that, then I don't qualify for, that doesn't qualify me for basis, because I'm not at risk of having to basically come up with that money. I mean, it's more complicated than that, but that's sort of the basics of that. That makes sense? That's my understanding of the rules.
I know there's some other questions. So I know you had your hand full.
To professional real estate activity. So what is the activity that you have to do to qualify as a real estate professional?
So the question is, what's the activity you have to do to qualify as a real estate
Is it
professional?
driving to the property? Is it doing bookkeeping? Is it sending someone? How do I qualify?
Yeah, literally everything you do that is real estate related, you are going to log to qualify for hours. So, I'm going to be more clear about that. If I'm a real estate broker, okay, my brokerage activities, my showing of properties to other people or whatever, qualify as part of my real estate professional status. If I am looking at properties as an investor, that time spent can be added to that, added up into that 750 hours. Going to the bank to ask for a loan for my property, looking at properties, driving to them, managing them, going to Home Depot to buy a bucket of paint for them. All of the different things that you do to facilitate the buying, holding, and selling of those properties qualifies as time spent. Now, what you want to do, though, is you want to track that, okay? And there's a whole lot of different ways to do it. I mean, I used to literally use I can't qualify anymore, so I don't track anymore, but I used to literally use a pad, okay, when I was a more active investor. Now there's apps. You know, there's an app for everything, right? So if you can if you have a time management app of some sort, you can use that to track the same way you would use an app to track your business miles, okay? Or you just say, hey, I spent 4 hours doing this today, and you write it down. The log that you're keeping is backup evidence for the fact that the IRS may ultimately question you on this. So in my scenario, there's an IRS agent in my neighborhood, there's an IRS agent in New Haven. All she does is audit real estate professional status. You walk in with your log, she looks at it and says, okay, have a nice day. You walk in and you say, well, wait a second, I do this, that, and the other thing. I certainly qualify. Where's your log? I don't have a log. Now you're going to be sitting there for a few hours, basically having a discussion, and you're probably going to lose. Okay? So the first 2 or 3 chapters of this book is about record keeping, because if you're not a good record keeper, you're probably leaving money on the table, and part of that is, tracking your professional status.
Does raising money qualify as real estate activity?
Sure. Yeah. Is it for real estate?
Yeah, for a deal.
Okay. Yeah. Absolutely. Irina?
Is claiming active real estate professional status more prone to have your return audited?
Are you more likely to be audited if you claim real estate professional status than if you don't?
You probably do have a larger audit risk, okay? But keeping this in mind, if my tax return says, if I have on my tax return 5 rental properties, and I have a Schedule C as a real estate broker, and I have other and I don't have a W-2 income, say for example, on my from somewhere else, okay? I'm a lot less likely to get audited than if I'm showing the same thing, but I have W-2 income from my engineering firm, or my contracting firm, or my accounting firm, okay? Now, the IRS looks at, if you do get in front of an agent, they're going to say, well, you have a full-time job. So I had a client who basically demanded that I make her a real estate professional, right? And I said, no, you don't qualify. You're an IT person and you spend, 2,080 hours down in Stamford, Connecticut, at your job, and you don't qualify. I know you're a part-time realtor, and she swore that she doesn't even sleep. All she does is her job in real estate, and she easily qualifies. And I say, okay, well, I don't think you do. I'm not going to do that on your return. So she said to me, okay, you're fired, right? And she left. So 2 years later, I get a phone call. Ted, she says, I really need your help. I'm getting called into the IRS's office in New Haven. They have questions about my real estate professional status. And I'm like, well, you don't need a CPA anymore. You need a lawyer, or David Copperfield, or somebody, because, you just pay the fine. You're wrong. And I told you were wrong, and you didn't listen to me, and you went and you did your own return, and I can't help you. What do you want me to say? So.
To your answer, the only thing you do is, like you said, being a broker and say investment products, or you're a syndicate. In other words, you don't have W-2 or 1099. Do you still need to keep that lock?
Yes, I would. Yeah, I would absolutely keep that lock. Okay, and the reason is, okay, that it's practical. Okay, there's always a chance I'm going to get called in. Okay, especially if I get to a year where I end up wiping out, all my earned income as a broker with my rental losses from a cost segregation study or something. There's always a chance you're going to get pulled, right? So it's relatively easy to do, and you should consider it part of your business, right? So I'm big on record keeping, because I'll give you an example. A lot of people say that accountants are conservative, right? Oh, my accountant, he doesn't even want to deduct half this stuff. He's so conservative, blah, 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 right? Well, the reason accountants are conservative is because we know a lot of you are sloppy record keepers, okay? And if we had to say to you, put your box of receipts together, you'd be like, right? So just like you wouldn't build a house on quicksand, okay? You don't want to build your real estate business on bad record keeping, especially if you're taking other people's money to do deals. If you guys are doing syndications, man, your accounting better be freaking good, you know? Because if you ever have a problem, okay, if you're 5 years down the road and you've got to do that refi, okay, and the economy has dropped a little bit, and you know the bank wants your financials and stuff, you better be able to put that stuff together, or you have a problem, you know. And if you can't give your clients reports, good reports, you have a problem. And sophisticated investors know the difference between good and bad reports.
So can we talk just for a couple minutes before you have to go about carried interests, like
Okay.
how they're taxed, so how they're treated, you know, how they work?
Okay. Not my strongest suit, but go ahead.
No, so carried interest, you know, at the end of the deal, you sell, you make X money, right? You have no basis, but because you didn't put any money on that deal, but you're still being taxed as if it were equity, right? As if it was a capital gains.
You're getting capital gains treatment. Yeah, that's the big benefit of that. You know, that's, you know, look, there's a sort of a movement against this carried interest treatment because a lot of people think it's very beneficial. You know, and it kind of is, right? It's a giveaway to people who, you know, make a lot of money and put together these kind of big deals, right? And it's used in the hedge fund business all the time. So that capital gain treatment is a lot better than the ordinary income treatment you would get if you were doing something else, right? So it's definitely advantageous. It's something you want to take advantage of.
Just to follow up to that, how can it be a capital gain if, as a sponsor, you didn't invest any money in the deal? Where is the starting point that you calculate the gain from?
Zero.
You're just saying it's zero as of the date of the deal, and that's...
Yeah.
Okay, so even though there's no actual entry in any bookkeeping, you're just, when you go to...
Think about it from this standpoint, right? I'm a real estate broker, or I'm a syndicator, I put together this deal. What really should be happening, okay, is that the money that I make for putting together this deal this is not the tax law, this is just a lot of people's opinion, should be ordinary income. You're doing your job, okay? Which means that it should be subject to the current ordinary income tax rates and probably self-employment tax also, okay? So now, I'm getting, because of the tax law, I'm getting preferential treatment, right? Okay, I'm getting capital gains treatment. So if I'm the syndicator, I'm like, would be, that's awesome for me, right? I'm gonna take capital gains treatment, even at there's a rate that you get that goes with that, but I'm still gonna take that because it's better than the ordinary. Why wouldn't I? Why wouldn't I take advantage? So that's the whole thing. The rule is there. Why not take advantage of it, right? The same way the rules are there for cross segregation, the same way the rules are there for 1031. As a real estate investor, I'm gonna use every rule that's available to me to reduce the amount of taxes I pay. And more than likely, if you're making money, you're still paying a fair amount of taxes. You're just getting it down to the lowest possible. And you know, there's been people, you know, Supreme Court justices that have said that's your obligation as an American, to reduce your taxes to the lowest possible. So take it for what it's worth.
One quick follow-up on that. Is there a differentiation between how long you actually hold the property? In other words, is there a differentiation between 1 year, over 1 year, or less than 1 year on the capital gains treatment?
Yeah, so the question is, to get the advantage of carried interest tax treatment, is there a holding period that you need to hold it for?
That's a good question. I'm not sure that I know the 100% guaranteed, you know, answer on that. But to the extent that it's over a year, you're obviously going to get that long-term treatment. I'm not sure whether you get short-term treatment or ordinary income treatment in year one.
I also had a question. Do you know anything about, and I hope this won't take too much time because it might be too big a question, but about this LLC rule, like on the new tax code, like you're now getting, if you own a business, if you own an LLC, you now get taxed. You have a special bonus, like not depreciation, deduction for
Oh, yeah,
operating through an
okay.
LLC.
Yeah, qualified business income
Yeah, yeah,
deduction.
yeah, that's-
Okay, yeah, I mean, look, this is,
I know you got one. Yeah.
No, I don't have to run. I mean, I do have to run, but I
Oh, okay.
go over 12 o'clock.
Oh, okay.
if you want.
Yeah,
So,
thanks. Okay.
so there's this thing called the qualified business income deduction. It's new for 2018, okay? And it applies to real estate investors who have net rental income, okay? Because it's based on a percentage of your income. Now, it also applies to business owners. So how many people in here own a business? Great. So the only kind of businesses it doesn't apply to are accountants, lawyers, financial service guys. We're kind of getting screwed. But most other businesses qualify, okay? And the thought process is, if I make $100,000 of net income in my business, I'm going to get a 20% deduction before I have to pay federal income tax, okay? So I make 100, I pay federal income tax on 80. That's the general rule. Now, the calculation is more complicated than that because it takes into account whether you took any wages from that business, what the capitalization in the form of fixed assets that business has, and a few other things, and there's income variables to it. But essentially, it's a 20% giveaway to business owners, okay? And it's something that we should all be going like, woo, this is awesome because, again, that 20% on $100,000 is probably a $6,000 tax cut for you, okay, give or take, right? On your net rental income, I mean, the whole idea is that we don't really want to have net rental income, but eventually we will have net rental income if we hold the property long enough. And at that point, that net rental income is going to be offset by that 20%. So I have a client who has a lot of mature properties, and he had $250,000 of net rental income this year, and he got a $50,000 qualified business income deduction, and he paid tax on 200 of it. And he was very happy with that. So.
You mentioned earlier that your advice is hold property forever. Why is that? Why do you think that people should hold property forever?
It's a little bit different with what you're teaching here because you've got these syndicated deals and a lot of those investors don't want to be in that property forever. And if you were trying to sell them that as part of the deal, it would be harder to do. But to the extent that you have your own properties, okay, that you own and you're operating, I don't really see any reason. So there's a bunch of disposal strategies. There's the 1031 exchange. There's pay the tax. That's a strategy. Another strategy says, hey, I'm going to hold these properties, okay, and when I die, my children are going to inherit them. And when they inherit them, they're going to get what's called a step up in basis, okay? So if I paid $1 million for a building and I've depreciated it down to nothing, okay? And if I sold it, I'd have $1 million gain. Now, if I held it until I died and then passed it to my children, okay, my children's basis in that property is now whatever the market value of that property was on the date of my death. So let's say the market value is $2 million, okay? Well, they inherit that property, their basis is now $2 million. They can sell that property the next day and take $2 million tax-free dollars. Okay, why? Even I had zero basis in that property. But it's the tax law. You get a step up. The tax law says you get a step up in basis. Okay, so why not? Now, are there some other rules that you have to take into consideration? Yes. On the federal level, in my particular example, there's no estate tax. Okay, the estate tax doesn't start until you're much higher up than $1 million, right? I'm not sure what the exact, where estate tax starts these days, but in the state of New York, for example, you may have a estate tax that starts at whatever it is, blank millions of dollars. In Connecticut, it's like 2-point-something million, and once you hit it or get over 2-point-something million, you have to start paying estate tax on that money. New York State, I know, has the same thing. I just don't know what the actual estate tax cap is. But yeah, so you have to take those things into consideration. But to the extent that you can pass along properties underneath the estate tax caps, it's a great strategy. You never end up paying taxes on it. And you could have leveraged up that using 1031 all the way up the line, and you never pay a dime in capital gains.
That's the idea.
We'll just take a couple more questions. And
So one thing I think just want to clarify what you said before is, so if I'm a passive investor and I get an income of, let's say, $10,000, and I have a K1 that shows negative $15,000, does that offset my just the 10,000 or my W-2 as well? So if I'm also have a W-2 job as a passive investor.
So if I have $10,000, if I understand the question, you have $10,000 of other passive income.
No, you just, from this deal, you got $10,000.
Okay.
Or whatever number it is.
Talking about distribution.
Profit.
you have to say 10,000. You've got 10,000
Profit.
probably from deal A.
A, and you have a K1 from deal A, which says negative whatever. And you have a W-2 job as well.
Oh, so you're saying you actually got 10,000 in cash from the deal,
Yeah.
but your K1 says you have a $5,000 loss. Can you offset that against other income from a job?
Right.
Right. So the answer to your question is your $10,000 that you got, that's your distribution from the
Right.
property. The amount that shows in your K1 is what you're going to get taxed on. Okay, so if you've got a negative 5,000, okay, that $10,000 is essentially tax deferred. Okay, you've that money, you're not paying tax on that money in the year you got it, right? Your K1 is what's going to govern what you put on your tax return. Okay, now, so in your scenario, you had a $15,000 loss on your K1. If you're a passive investor with no other passive income, you cannot deduct your $15,000 against your W-2 income. Your net rental income for the year would be zero, and you would have a $15,000 carryover.
Till you have another passive income.
So you either have other passive income, or your income, you're qualified for a different status because
So basically it does not offset the W-2 income.
doesn't offset the W-2 income until the year of sale. And then in the year of sale, you get all of that back. So if you had a $10,000 carryover for 10 years, in the year of sale, you would get the $100,000 loss.
And does the real estate professional status change that at all, or does not?
The real estate professional status absolutely changes it. That's the benefit of the real estate.
So now you can offset.
In the real estate, if you're a real estate professional, you're deducting that $15,000 against your W-2 or brokerage income or whatever.
Can I just follow up to that?
Go ahead.
Speak up.
So your spouse, married father, your spouse is a real estate professional. Can you use passive losses to offset W-2 income from a non-real estate related business if your spouse is the real estate professional?
Okay, so if my spouse is a real estate professional, right, then yeah, you can, right? Is she holding some of the investment or is she not holding some of the investment?
You tell me.
Well, I don't think it matters, okay, because your spouse is a real estate professional. But if I knew my spouse was a real estate professional, I would probably make it less auditable by structuring it a little bit differently. Does that make sense? In other words,
So how would you structure it?
I might put her in as the partner instead of myself. Maybe, depending on what I'm doing. Again, very specific,
Yeah.
but if your spouse is a real estate professional, you do get the qualification of the losses, whether or not you make it or not.
So your non-real estate related W-2 income
Is offset, yeah.
is offset.
Mm-hmm.
Thank you.
Yeah, you're welcome.
Okay. One last question, if we. Any last questions? Martha? Yeah.
And I'm going to go back to the beginning. You spoke about a deduction about over 25,000. And you get a range over there if you're having an income of 100 or 150,000.
Right.
Can you repeat that?
Okay, so in between,
Different, like if
Yeah.
the income from real estate or different business?
So I'm just going to restate it for the video. So the question was, in the beginning, Ted said that there's a $25,000 deduction for real estate income that you may or may not qualify for depending on your income. And Matan had asked, explain that a little bit more. So,
okay. So in between, there's a category of investor that's in between passive and real estate professional. And that category is called active investor. If I'm an active investor, that means that I own and manage my own properties, okay? And I am tracking, so if I have a management company, I don't qualify as active, okay? But if I own properties and I'm actively managing them, even if it's just directing the activities of realtors, contractors, maintenance, that sort of thing, okay? So if I'm doing all that and I'm tracking it like I would a professional, because I need to qualify, I believe, 550 hours, okay, to qualify. But if I'm doing that, right, then I'm allowed to take up to $25,000 of my rental losses against my ordinary income. So I'm an accountant. I make $100,000 a year. I'm also an investor. My rental properties threw off with depreciation a loss of $25,000. I'm allowed to take that $25,000 loss against my 100. So now I'm going to pay tax on $75,000. Okay. If my salary goes up to 150, I get zero of that $25,000 loss because I've been phased out. Okay. I'm losing, for every $1,000 I make over 100,000, I'm losing 500 of that $25,000 loss ability. So if I make 101,000, I can only deduct 24,500, 102, 24, and all the way up the line.
So,
Okay, go ahead. Yeah.
So what if I show up at the end of the year, the rental property was a positive cash flow, right? And we put in the deduction, the regular deductions, right? The depreciation, and then I take this one, the 25,000?
No, so let's say you added up all of your rental income. Let's say you had one property and you said, okay, my rents minus my expenses
For
are,
like $40,000.
okay, right? So I took my rents and I subtracted my expenses and I netted $10,000. And when I apply my depreciation, right, let's just go wild and say you had $35,000 worth of depreciation, so you have exactly a $25,000 loss, right? If you make under $100,000, you're eligible to, and you're actively managing that property, you're eligible to deduct that $25,000. If you only lost 10 after depreciation, then it's 10. It's not an automatic 25. You had to lose the 25, but it's up to 25,000 of losses.
And the 10 is still tax free, still tax deferred. That 10 that
the 10 that the cash you made is still tax deferred. That's why you want to invest in real estate, because you want to have tax deferred cash.
Okay, last question, can you, yeah.
Is that income bracket single or married? It just depends how you come out. You said
Does the 25 depend on-
$100,000, like the income range.
150 is.
There's a different, when I say 25 and 150, I'm talking about married filing jointly.
Okay.
There's, if you're single, I think you still can get to 25, but there's a lower bracket that I think it might be once you hit over 75 or something. But here's the thing I want you to keep in mind also. And this is, and I talk about this in the book, is proactive planning, okay? So if I've got $110,000 worth of W-2 salary income, for example, right? And I know that I'm going to get phased out partially of my rental losses, but I could say, for example, put money in my 401k at work and bring my salary down to, my taxable salary down to 98 and take the full benefit. Or I own a business and I'm going to buy a vehicle in my business and get my business income down below 100,000, okay? All of these different things are things that we do in October, November, and December so almost all tax savings happens in October, November, and December, not in March and April. Okay, make sense? So if just to leave this, on a very positive note, you should be there's 4 times when you should be contacting your CPA. When you buy a property, when you sell a property, when you renovate a property, and right before year end. Okay, because it's all the good stuff comes to the proactive people who plan before year end. Okay?
Ted?
Thank you so much. I appreciate it. Thank you so much.